everybody. Welcome to the weekly market update with ProsperUS, with myself and Billy.
Hi, guys.
Today we'll be covering the Fed and how to invest in a bear market. So I think first off, maybe we can talk about what happened last week with Jay Powell, and how do you think the market reacted to his comments, Billy? What's your take?
I think that's what the Fed was trying to achieve, right? They wanted the market to stop going, the rally to sort of stop, to come to face with the reality that the rising interest rate is going to continue. And I think they've achieved what they want to achieve. I mean, I remember when we talked about the earnings in Singapore last week, was talking about the Singapore bank, and I say that if the recessions in US were to be worse off, I think that's partly going to be driven by the Fed rising interest rate and the monetary policy tightening. So I think it's as per what they wanted it to happen, and I think I think that if the Fed were to continue on this aggressive monetary policy tightening path, I think we will be looking at a longer, prolonged bear market rather than a short blip that what we have used to over the last decade.
Yeah. So I think the Fed, definitely wanted to put the market's doubts to bed. I mean, clearly the market rallied in July quite strongly, thinking that there would be easing in the early part of 2023. But if you think about what the Fed's inflation target is, it's at 2%, right? And so July numbers came in at better than expected, but it was still something like 8% or 8.4%. So it's way, way, way off where it should be for the Fed. So I think what he said last week is that they expect it to be maintained at a higher level for some time. So I think that scared investors, and it scared the market, right? So I think that's what he intended to do. But I think for the dual mandate of full employment and low inflation, I think that's the right course of action. It seems to be the right way that he's going about it. So how do we think about investing in an environment where maybe inflation's a bit more entrenched and interest rates are higher? What's your sort of key strategy in this environment?
I think at the end of the day, it really depends on your time horizon, how long you plan to invest in, right? I guess for someone who are probably reaching their retirement age, I think it's probably best to relook at the asset allocation strategies to ensure that you're not overly skewed to risky assets. But I think if you're like myself, you're at 30 plus and you still have quite a long way to go before retirement, I think the strategy remains the same. And I don't think it's the right call to panic sell at this point. I think it's really about looking at companies that have strong balance sheets and business model that can withstand the current market volatility. So I think for like Singapore investors, for example, I think it really, you have to just look beyond just Singapore, for example. I mean, Singapore has quite a lot of room for investors to play around, like the Singapore REITs, if you are looking for dividend income investors. But I think it's also important to look beyond just Singapore, to look at other markets, especially if you're looking at a longer term horizon, right? I think some of the stocks in US, they have very strong cash cow business, the very resilient business model. Like I think we talk a lot about this, like Microsoft. So so I think even if you're looking at technical recessions or even a prolonged slowdown over the next 1 year, I think companies like this would be able to withstand this slowdown in the upcoming years.
Yeah. I mean, my personal take is, it's more about adjusting your risk profile and your allocation according to how risky you want your portfolio to be. I think there obviously valuations in tech got way overextended last year and they've come back down, but a lot of these businesses are still doing very, very well. As you said, Microsoft and the big tech guys, I think, are very resilient companies with massive free cash flow, operating cash flow. So I think when you think about businesses to buy into in this period, they really need to have a very strong free cash flow and be like very, very strong balance sheets. So preferably a net cash position, not a lot of debt. With rising interest rates, you don't want companies that have a lot of debt on their balance sheet or that are going to be overextended when they have to pay back their debt. So you're looking at a lot of companies in the US that have this history of really strong free cash flow, really strong operating cash flows, and strong balance sheets as well. So they will be going on sale if there is another sort of dip in the market here or a leg down in the market. So if you think about what are defensive sectors naturally, you've got healthcare, you've got utilities, and consumer staples. But I think some of these consumer staples names are starting to become a bit more expensive
Yeah,
in
yeah, they
this
are.
environment. So I think for investors, we should be watching closely over the next few months how earnings are coming, I guess, over the next 2 quarters towards the end of the year. And especially the holiday season, that's going to matter a lot for retail, right, in the US. So I think retail earnings are something to keep a close eye on, because that's going to be a barometer for the US economy as a whole, and how well the US economy is able to withstand these interest rate hikes that the Fed has coming. So yeah, I think on the whole, it's more a case of positioning according to your own risk, diversifying obviously as well, like buying both growth and dividend income stocks, and thinking about where you want to, where you see the best opportunities in the market right now.
Yeah, I mean, just to put into perspective, right? I mean, if you look at the region, if as a Singapore investors, the Singapore market has been pretty resilient over the years, and if I were a Singapore investor, I'll probably continue to invest on the REITs players, because I mean, even despite of the rising interest rate environment, if you look at a lot of them have actually hedged their borrowings to a fixed rate, so that the impact of it would not really be there.
Yeah.
Of the impact on the interest cost and all that. So I think it really gives them that room to go for it. But aside from that, you could also look at other regions. Like, I mean, for example, in Malaysia, if you compare Malaysia and Singapore stocks, Malaysia has not been performing over the last 5 to 6 years, partially due to, I think, political reasons, as well as the commodity slowdown at that time, right? But so you could see there's quite a bit of opportunities that you could really play on. But it really depends on, like I said, if you are already at the time that you are reaching your retirement age, then probably you do not want to take as much risk, right? But if you're not, then there's probably some other opportunities that you can play. And I think the other day we talked to you about sell call position on some of the stocks, like say Intel, and I think those are sell call options. So those are ways that you could actually play around with the current bear market as well. So I think it just gives you that opportunities to tap on the market in a different way, rather than the usual rally that you saw, So it really is that opportunity that is there.
Yeah.
But I think that the collapse in some of the stock market, especially when the panic, if you read from the headline, they talk about the bear market, I think it's overdone in a sense. So I think investors should look beyond that, because if you are investing, say 5 to 10 years period, so this will really be the opportunities for you to buy into some of these good companies.
Yeah, definitely. I think, Warren Buffett's right in that saying about, how people run out of the store. People wouldn't run out of a store if stuff goes on sale for 20, 30%, right? But in the stock market, everyone flees when things go on sale. So I think it takes a lot of discipline for investors to think longer term. Think about the business. Is it the same business it was, a year earlier, or is it even better than it was a year ago? And is it cheaper than it was a year ago? And if it's a lot cheaper and it's still the same business or even better, then I think investors can be happy, picking up shares for the long term if they're going to hold it longer term. So just have that in mind, and when you invest in the stock market.
Yeah, and I think just want to add this before I close, that there's also this team that people can really look into, like the reopening of the economy, and I think there's a transition to a new normal per se. We don't have a home remote working business model back pre-COVID, right? And right now we have some of this as well. So things are a bit different in a sense. So you can see that transition. So you can really tap on some of the opportunities, like, Singapore Airlines is one of those that are probably going to come back, right? So you really want to look at some of the opportunities that are going to come about as people transition to this. I would say the normal that we used to have, it is really a transition, that period. But aside from that, I don't really think that there should be any panic on looking at the market. Right.
No, definitely.
Yeah.
Okay, I think that's a good roundup of the week and the lessons that we've taken away. So until next week, thank you for your time, Billy, and we'll speak next week.
All right.
Bye, everybody. Bye.